When it comes to ETFs, they are really the hidden gem when it comes to wealth creation. And of course, we know they are emerging as one of the most popular investment vehicles that we see. And the reason I invest in ETFs, we are going to be sharing in this video. Now, there are a lot of advantages over ETFs, and especially when it comes in relationship to mutual funds. Now, we know Dave Ramsey traditionally falls back to investing in mutual funds and only mutual funds, but mutual funds do come with a significant cost. So let's go ahead into this video, and I'm going to break down the ETFs and why I invest in only ETFs when it comes to my portfolio, which of course the starting one, which is the most important, diversification and the risk management. That is right. When you look at an ETF, let's say the VOO is the example we're going to be using for this video, you are offered a diversified portfolio of assets. And when you look at the VOO, which covers the S&P 500, it spans all of our sectors, all of our industries, and all of our geographic locations within the United States. So it literally covers the 500 largest companies within the United States, which means as an investor, you're not picking and choosing stocks, bonds, whatever it may be. This can spread your risk across multiple securities, including a lot of different ones depending what it's invested in. And when you look at your portfolio, and we have even seen this from Warren Buffett, we're looking at Berkshire Hathaway. A big chunk of Berkshire Hathaway is invested in the S&P 500. And over the last, I believe it is like 25 plus years, we have seen around a 10 to 12% return, which is kind of crazy. Now, of course, when it comes to ETFs, you can also invest in equities, bonds, commodities, real estates. ETFs are a very convenient, very consolidated way to diversify your assets. And of course, they come with a lower expense ratio than we see with mutual funds. This is one of the absolute key advantages. When you look at some mutual funds, it could be 1%, it could be 1.5%, because of course, with mutual funds, they are managed funds. That is really the big part. When you look at ETFs, ETFs have a much lower expense ratio, even looking at them at a 0.03%, which is kind of crazy. And there are additionally some ETFs that literally charge nothing. They have a zero expense ratio for some of these ETFs, which is kind of crazy. If you do a quick Google search, zero cost ETFs, there are a few that are sold from Fidelity and a few other places that literally, it costs you nothing to hold the fund. There is no expense ratio at all. Now, of course, in comparison, when you start looking at mutual funds, there are fund managers for these mutual funds, and you are paying for their guidance, you are paying for their advice. And overall, sadly to say, a majority of financial advisors, and they roughly say 86%, cannot beat the market. That is right. If we're investing in that VOO, if you're investing in the S&P 500, chances are the financial advisor cannot beat the market, and a majority of them do not beat the market. And then when you start extending it out to multiple years, again, most investors do not beat the market by any means, which is kind of crazy. So of course, when you start looking at, 20, 30, 40, 50 years that you're investing, if you have it in mutual funds, that 1% actually is extrapolated over that amount of time, meaning that you could give up as much as 30% of your portfolio if you do have it in mutual funds. Now, of course, when it comes to ETFs, I do all of my investing through M1 Finance. I have a link down below if you want to do the referral, because they offer liquidity and the trading flexibility, which is the next one we look at. And of course, if you like the content that I'm putting out with the videos, definitely subscribe to the channel. ETFs are traded on the stock exchange through market hours. So this is regular markets, meaning that it is closed during holidays, it is closed during weekends, but you have a ton of liquidity and flexibility, which unlike some mutual funds, which again, you're paying or you trade at the end of the day, ETFs trade in real time, similar to what we see with stocks. There's intraday trading, there's enabling really the investors to buy and sell at the market prices in real time. So if the market's really coming down, let's say 5-10% a day, which is kind of crazy, you have the ability to liquidate the ETF, and it's not going to wait like a mutual fund does till the end of the day to go ahead and sell that mutual fund. But that makes it very active for traders, especially if you are active traders and if you are looking to move money. Now, of course, this one is huge, which is tax efficiency. Now, the ETFs are structured in a way that they have a greater tax efficiency for investors compared to mutual funds. This again is a really big incentive for the ETFs that we talk about. The creation and redemption process of ETF shares, coupled with the ability to offset capital gains within the fund itself, can minimize the tax implications for ETF investors. Additionally, ETFs are generally more tax efficient in terms of dividends and capital gains to shareholders, making them the preferred choice over mutual funds when it comes to anyone who is tax conscious as an investor. Now, again, that really sums it up when it comes to the tax efficiency in the ETFs, not only how they treat dividend distributions, but also how they treat capital gains. It is taxed differently than what you're going to see in a mutual fund. And of course, like we said earlier, transparency and accessibility. ETFs offer transparency about the features they provide to their investors with viability into the underlying holdings of the fund on a regular basis. So when you start looking at a fund, and again, using the VOO, you can see every single stock that is held within that ETF, which is the transparency. Now, transparency, of course, very similar to my role, it instills confidence among investors. And of course, you can monitor the fund's performance and the compensation of what they do have within that fund. And of course, it is accessible to all retail investors with minimum investments. When you look at, again, M1 Finance, you got to put $100 in there, and that can start your entire investing journey. And if you're unfamiliar with investing, I really say start there. When you think about putting a lot of capital in, when you think about the investment strategy, putting in a very, very small amount or putting in even small amounts over an extended amount of time can be super beneficial to really get your feet wet and start getting familiar with ETFs, stocks, bonds, equities, whatever it may be, but getting familiar with what you're trading in. Because again, I really pass on the generational wealth of never invest in something that you don't know what it is, never invest in something that you don't know how it works. If you have question marks about it, you better do all your research, you better do all your education, and making sure that you know exactly what you're putting into. Now, of course, when it comes to ETFs, investing, really it allows individuals of all financial backgrounds. If you're very basic, just starting to study ETFs and what they do carry. If you're a veteran investor, both of you can invest in the exact same ETFs on the exact same market. And of course, ETFs have customization and specialization. Now, this is super important to remember if you want to start getting into little bit more of a riskier ETFs. We see one that are very, very specific to sectors or themes that are really looking at technology, healthcare, renewable energies, emerging markets. There's a lot of ETFs right now that are focused around artificial intelligence. There's a lot like the VUG that are based on growth. So when you start looking at different ways to kind of leverage ETFs, not only having that super low expense ratio, but also having the ability to really tailor your investment strategy to your individual goal and also the amount of risk that you want to have within those ETFs, it is really a game changer. Now, of course, when you start looking at those ETFs, there are so many multitude of benefits for investors: diversification, the risk management, the cost efficiency, the flexibility, the taxation, transparency, accessibility, and of course, the ETFs have that customizable aspect, meaning that you can invest in one ETF or you can invest in a bunch of different ETFs, again, if you really want to mitigate that risk and really build out that portfolio. Now, guys, that is one of the reasons why me personally, I only invest in ETFs. When you start doing comparisons of the performance of ETFs, especially those index funds over an extended amount of time in relationship to a lot of mutual funds, you are paying an individual to manage the fund. Where again, if you think big picture, let's say for instance, you wanted to invest in the VOO, you're investing in that Vanguard S&P 500. Literally, if that was your only investment for your life, so everything you had went right into that VOO, you would still be doing incredibly well with those top 500 companies in the United States and really have a massive portfolio with the compounding interest that you do see in there. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.